Question 1. A life insurance policy owner stops paying premiums on a whole life policy with a significant cash value. The policy includes a provision that automatically prevents it from lapsing by using the accumulated cash value to pay the overdue premium. Which of the following non-forfeiture options is being utilized? A. Extended term. B. Reduced paid up. C. Cash surrender value. D. Automatic premium loan. Answer: D. Automatic premium loan. The automatic premium loan provision is designed to prevent a policy from lapsing due to unpaid premiums by automatically borrowing from the policy's cash value to cover the missed payment. This option keeps the original policy in force with its full face amount, minus the loan and any interest, rather than converting it to a different type of coverage or terminating it. For instance, if a premium is due and the policyholder forgets to pay, this feature uses the existing cash value to keep the policy active. Remember that while this protects the policy from lapsing, any outstanding loan will reduce the death benefit payable. Question 2. An individual surrenders a non-qualified deferred annuity after accumulating significant earnings. Which portion of the distribution will be subject to ordinary income tax and potentially a penalty tax if the annuitant is under age 59.5? A. Only the original premium payments returned. B. Only the interest earnings accumulated. C. Both the original premium payments and the interest earnings. D. Neither portion, as annuities are tax-deferred. Answer: B. Only the interest earnings accumulated. When surrendering a non-qualified deferred annuity, only the growth or interest earnings are considered taxable income, not the return of the original premium payments, cost basis. This is because the premiums were paid with after-tax dollars. The last in, first out, LIFO, rule applies to withdrawals, meaning the earnings are assumed to be withdrawn first and are subject to ordinary income tax. Additionally, if the annuitant is under age 59.5, a 10% penalty tax may apply to the taxable earnings portion of the withdrawal. This tax treatment incentivizes long-term savings but subjects early withdrawals of earnings to penalties. Question 3. A 67-year-old individual retired recently and is concerned about the costs associated with a potential extended stay in a nursing home or receiving care at home. Which type of insurance policy is specifically designed to cover these expenses, which are generally not covered by Medicare? A. Medicare Supplement, Medigap. B. Short-term medical insurance. C. Long-term care insurance. D. Accident-only insurance. Answer: C. Long-term care insurance. Long-term care, LTC, insurance is specifically designed to cover the costs of assistance with activities of daily living, ADLs, or cognitive impairment, whether received in a nursing home, assisted living facility, or at home. Medicare generally does not cover custodial care, which is the primary focus of LTC. This distinction is crucial because Medigap policies primarily supplement Medicare's coverage for hospital and medical expenses, not long-term custodial care. Understanding the specific purpose of LTC insurance helps consumers fill a significant gap in their healthcare coverage as they age. Question 4. A California applicant for a life insurance policy makes a material misrepresentation on the application form. The insurer discovers this misrepresentation 2 years and 1 month after the policy was issued. Which of the following actions can the insurer take regarding the policy? A. Rescind the policy and deny the claim, regardless of the misrepresentation's relation to the cause of death. B. Rescind the policy only if the misrepresentation was intentional fraud and directly related to the cause of death. C. Adjust the policy's face amount or premiums to reflect the correct information as if it had been known. D. The insurer cannot rescind the policy due to the Incontestability Clause. Answer: D. The insurer cannot rescind the policy due to the Incontestability Clause. The Incontestability Clause in a life insurance policy, typically effective after 2 years from the issue date, prevents the insurer from denying a claim or rescinding the policy due to material misrepresentations on the application, even if fraudulent. Since the discovery of the misrepresentation occurred after 2 years and 1 month, the policy is considered incontestable. This clause protects policyholders from arbitrary cancellations after the contestable period has passed, providing certainty that their policy will pay out if they meet their obligations. For example, if an applicant lied about their smoking status and died from a non-smoking related illness after 2 years, the insurer would still have to pay the claim. Question 5. An agent completes an application for a life insurance policy and collects the initial premium from the applicant. The agent issues a conditional receipt. Which statement best describes the coverage provided by this receipt? A. Coverage begins immediately on a temporary basis, regardless of the applicant's insurability. B. Coverage begins on the date of application or date of medical exam, whichever is later, provided the applicant is found to be insurable according to the insurer's underwriting standards. C. Coverage is guaranteed to begin from the moment the receipt is issued, pending policy delivery. D. No coverage is provided until the policy is formally issued and delivered by the insurer. Answer: B. Coverage begins on the date of application or date of medical exam, whichever is later, provided the applicant is found to be insurable according to the insurer's underwriting standards. A conditional receipt provides interim coverage, but its effectiveness is contingent upon the applicant meeting the insurer's underwriting requirements. It means that if the applicant is found to be insurable as of the date of the application or the date of the medical examination, whichever is later, coverage is considered to have been in force from that date. This protects the applicant by potentially providing coverage earlier than the actual policy issuance date, but only if they would have qualified for the policy anyway. Always remind applicants that a conditional receipt does not guarantee policy issuance, only potential interim coverage. Question 6. All of the following are typically included in the consideration clause of a life insurance policy, except A. The applicant's statements on the application. B. The insurer's promise to pay the death benefit. C. The amount of the premium paid. D. The frequency of premium payments. Answer: B. The insurer's promise to pay the death benefit. The consideration clause in an insurance contract outlines the legal consideration given by the policy owner to the insurer for the policy to be valid. This typically includes the payment of premiums and the truthfulness of the statements made in the application. The insurer's promise to pay the death benefit is the insurer's part of the contract, but it is not considered part of the consideration provided by the policy owner within the consideration clause itself. Think of it this way: what does the policyholder give to the insurer? They give premiums and truthful information. Question 7. A group health insurance policyholder switches from an HMO plan to a PPO plan. One of the employees was undergoing treatment for a pre-existing condition under the old HMO plan. Under the new PPO plan, what is most likely to happen regarding coverage for this pre-existing condition, assuming the employee met the waiting period requirement under the previous plan? A. The PPO plan will immediately deny coverage for the pre-existing condition. B. The PPO plan must credit any time the employee was covered under the previous HMO plan towards any new pre-existing condition waiting period. C. The employee must undergo a new pre-existing condition waiting period under the PPO plan. D. The PPO plan will only cover the pre-existing condition if the employee pays an additional surcharge. Answer: B. The PPO plan must credit any time the employee was covered under the previous HMO plan towards any new pre-existing condition waiting period. Under HIPAA, Health Insurance Portability and Accountability Act, group health plans must credit prior creditable coverage towards any pre-existing condition waiting periods. This means that if an employee was covered under a previous group health plan, such as an HMO, and then enrolls in a new group plan, the time spent under the old plan counts towards fulfilling the new plan's pre-existing condition waiting period. For example, if the new PPO has a 12-month waiting period and the employee had 6 months of coverage under the HMO, only an additional 6 months, if any, would apply. This provision ensures continuity of coverage and prevents individuals from losing coverage due to changing jobs or plans. Question 8. A policy owner purchases a participating whole life insurance policy and elects the paid-up additions dividend option. Which of the following statements accurately describes the effect of this option? A. The dividends are used to reduce the next premium payment. B. The dividends accumulate at interest and can be withdrawn at any time. C. The dividends are used to purchase small, single-premium whole life policies that add to the face amount and cash value of the original policy. D. The dividends are paid out to the policy owner in cash. Answer: C. The dividends are used to purchase small, single-premium whole life policies that add to the face amount and cash value of the original policy. The paid-up additions dividend option uses any declared dividends to purchase additional, fully paid-up whole life insurance coverage. Each small addition increases the policy's overall face amount and cash value, making the policy grow faster over time. Unlike simply accumulating at interest, these additions themselves earn dividends and contribute to the policy's cash value, further compounding growth. This is a powerful option for policyholders who want to maximize their policy's death benefit and cash value without paying additional out-of-pocket premiums. Question 9. An applicant for a life insurance policy submits an application but does not pay the initial premium. The policy is issued and delivered to the applicant. When does the policy typically become effective? A. On the date the application was signed. B. On the date the policy was issued by the insurer. C. On the date the policy is delivered to the applicant and the first premium is paid. D. On the date the medical examination, if any, was completed. Answer: C. On the date the policy is delivered to the applicant and the first premium is paid. If the initial premium is not paid at the time of application, the general rule is that coverage does not become effective until the policy is delivered to the applicant and the first premium is collected. This is known as the delivery and payment rule. The policy delivery serves as the final step in the formation of the contract, confirming the insurer's offer and the applicant's acceptance through premium payment. Always ensure both conditions are met to ensure proper policy activation. Question 10. Which of the following is considered an unfair trade practice known as churning in California? A. An agent replacing an existing policy with a new one that provides a clear and substantial benefit to the insured. B. An agent misrepresenting the terms of a policy to induce an insured to purchase it. C. An agent encouraging a policyholder to frequently surrender existing policies and replace them with new ones primarily to generate new commissions for the agent. D. An agent offering a prospective client a valuable gift as an inducement to purchase insurance. Answer: C. An agent encouraging a policyholder to frequently surrender existing policies and replace them with new ones primarily to generate new commissions for the agent. Churning is an illegal and unethical practice where an agent induces a policyholder to replace an existing policy repeatedly, not for the policyholder's benefit, but to generate new commissions for the agent. This often results in the policyholder incurring new surrender charges or starting new waiting periods, leading to financial detriment. The key indicator of churning is that the replacement serves primarily the agent's financial interest rather than providing a clear benefit to the insured. This practice violates California's Unfair Practices Act. Question 11. An insured individual becomes totally disabled and is receiving benefits from their disability income policy. The policy includes a waiver of premium rider. What effect does this rider have on the policy? A. The policy's cash value continues to grow, but no further premiums are required while the insured remains disabled. B. The policy terminates, and the insured receives a lump sum payment. C. The policy continues, but the insured must pay a reduced premium amount. D. The policy's benefits are temporarily suspended until premiums resume. Answer: A. The policy's cash value continues to grow, but no further premiums are required while the insured remains disabled. A waiver of premium rider is a valuable feature often added to life or disability insurance policies. If the insured becomes totally disabled, as defined by the policy, this rider waives all future premium payments for the duration of the disability, while keeping the policy fully in force. This means the policy's cash value will continue to grow for whole life policies, and the death benefit or disability income benefits will remain active. It prevents the policy from lapsing due to an inability to pay premiums during a period of disablement. Question 12. Which type of life insurance policy is characterized by a level premium, a level death benefit, and a cash value that grows over time, eventually equaling the face amount at age 100? A. Universal life. B. Term life. C. Variable life. D. Whole life. Answer: D. Whole life. Whole life insurance is a form of permanent insurance defined by its fixed, level premium and a guaranteed level death benefit that remains constant throughout the insured's life. A key characteristic is the accumulation of cash value on a guaranteed basis, which can be accessed through loans or withdrawals. The cash value is designed to equal the face amount of the policy when the insured reaches age 100, at which point the policy matures and typically pays out. This predictable growth and lifelong coverage distinguish it from flexible premium policies like universal life or temporary coverage like term life. Question 13. An agent is licensed in California and plans to move to another state. To maintain their license in California while residing in the new state, the agent must notify the commissioner of the change of address. Within how many days must this notification be made? A. 10 days. B. 15 days. C. 30 days. D. 60 days. Answer: C. 30 days. In California, an insurance agent must notify the insurance commissioner, in writing, of any change of address within 30 days of the change. This requirement ensures that the Department of Insurance can maintain accurate records for communication and regulatory purposes. Failing to do so can result in fines or administrative actions. This rule applies whether the agent is moving within California or to another state while still holding a California non-resident license. Question 14. Which of the following is true regarding a modified endowment contract, MEC? A. Policy loans and withdrawals are taxed on a first-in, first-out, FIFO, basis. B. It is a life insurance policy that has met the 7-pay test and receives favorable tax treatment on distributions. C. Distributions, including loans, are taxed on a last-in, first-out, LIFO, basis and may be subject to a 10% penalty if taken before age 59.5. D. It loses its tax-deferred growth characteristic once it becomes a MEC. Answer: C. Distributions, including loans, are taxed on a last-in, first-out, LIFO, basis and may be subject to a 10% penalty if taken before age 59.5. A modified endowment contract, MEC, is a life insurance policy that has failed the 7-pay test, meaning cumulative premiums paid during the first 7 years exceed a specified limit. While the cash value still grows tax-deferred, distributions, including policy loans and withdrawals, lose their favorable, first-in, first-out, FIFO, tax treatment and are instead taxed on a last-in, first-out, LIFO, basis, meaning earnings are withdrawn first and are subject to ordinary income tax. Furthermore, these taxable distributions may incur a 10% penalty tax if the policyholder is under age 59.5. Understanding MECs is crucial because it significantly impacts the tax implications of accessing policy cash values. Question 15. All of the following are typically considered activities of daily living, ADLs, used to determine eligibility for long-term care insurance benefits, except A. Bathing. B. Dressing. C. Cooking. D. Transferring, e.g., moving from bed to chair. Answer: C. Cooking. Activities of daily living, ADLs, are fundamental self-care tasks that people need to perform regularly. They are commonly used as triggers for long-term care insurance benefits. The 6 generally recognized ADLs are bathing, dressing, eating, transferring, toileting, and continence. Cooking, while an important instrumental activity of daily living, IADL, is not typically one of the core ADLs used for benefit triggers in LTC policies. Insurers define these triggers to objectively determine when someone needs assistance with personal care. Question 16. A policyholder has a decreasing term life insurance policy. Which of the following statements is true regarding this type of policy? A. The premium decreases over the policy term, but the death benefit remains level. B. Both the premium and the death benefit remain level throughout the policy term. C. The premium remains level, but the death benefit decreases over the policy term. D. Both the premium and the death benefit decrease over the policy term. Answer: C. The premium remains level, but the death benefit decreases over the policy term. Decreasing term life insurance is designed for situations where the need for protection decreases over time, such as covering a mortgage balance. With this type of policy, the premium typically remains level throughout the policy's term, while the face amount or death benefit gradually declines. For example, as a mortgage is paid down, the amount of insurance needed to cover the remaining balance also decreases. This allows the policy to align with a diminishing financial obligation. Question 17. The primary purpose of the Medical Information Bureau, MIB, is to A. Provide insurers with a complete medical history of every applicant, including all diagnoses and treatments. B. Prevent applicants from misrepresenting their health status on insurance applications and detect fraud. C. Share prescription drug histories between insurers to assess risk. D. Serve as a public database for individuals to check their own medical records. Answer: B. Prevent applicants from misrepresenting their health status on insurance applications and detect fraud. The Medical Information Bureau, MIB, is a non-profit organization that maintains a database of health information reported by member insurance companies. Its primary purpose is to serve as an alert system, helping insurers detect and prevent fraud or misrepresentation by applicants. It does not contain complete medical records or diagnoses, but rather coded information about medical conditions or hazardous activities that applicants reported to other insurers or were discovered during their underwriting process. This helps insurers assess risk more accurately and efficiently, while protecting applicants' privacy by only revealing certain codes, not full details. Question 18. An individual enrolls in a high-deductible health plan, HDHP, and wishes to contribute pre-tax money to a savings account for qualified medical expenses. Which type of account is designed for this purpose and is available only to those enrolled in an HDHP? A. Flexible Spending Account, FSA. B. Health Reimbursement Arrangement, HRA. C. Health Savings Account, HSA. D. Medical Savings Account, MSA. Answer: C. Health Savings Account, HSA. A health savings account, HSA, is a tax-advantaged savings account specifically designed for individuals enrolled in a high-deductible health plan, HDHP. Contributions to an HSA are tax-deductible, the money grows tax-free, and withdrawals for qualified medical expenses are also tax-free. Unlike FSAs, HSA funds roll over year to year and are portable, meaning they belong to the individual even if they change employers. HSAs provide a triple tax advantage and encourage consumers to be more mindful of healthcare costs. Question 19. Under the Affordable Care Act, ACA, which of the following is not considered an essential health benefit that must be covered by most health insurance plans? A. Ambulatory patient services. B. Maternity and newborn care. C. Adult dental and vision care. D. Prescription drugs. Answer: C. Adult dental and vision care. The Affordable Care Act, ACA, mandates that most health insurance plans cover 10 categories of essential health benefits, EHBs, to ensure comprehensive coverage. These include ambulatory patient services, emergency services, hospitalization, maternity and newborn care, mental health and substance use disorder services, prescription drugs, rehabilitative and habilitative services and devices, laboratory services, preventive and wellness services and chronic disease management, and pediatric services, including oral and vision care. However, adult dental and vision care are generally not included as mandatory EHBs, though some plans may offer them as optional riders or separate policies. Question 20. In California, if a life insurance policy lapses due to non-payment of premium and the policy has a cash value, the insurer must provide a non-forfeiture benefit. Which of the following is not one of the standard non-forfeiture options? A. Extended term insurance. B. Reduced paid-up insurance. C. Cash surrender value. D. Automatic premium loan. Answer: D. Automatic premium loan. The automatic premium loan is a policy provision that helps prevent lapse by borrowing from the cash value to pay premiums, but it is not one of the three standard non-forfeiture options that must be offered when a policy lapses. The three standard non-forfeiture options available to a policy owner upon surrender or lapse of a cash value policy are extended term insurance, uses cash value to buy a single premium term policy for the same face amount for a limited time, reduced paid-up insurance, uses cash value to buy a single premium whole life policy for a reduced face amount for the remainder of life, and cash surrender value. The policy owner takes the cash value and the policy terminates. Question 21. An individual owns an accidental death and dismemberment, AD&D, policy with a principal sum of $100,000. If the insured loses one hand in an accident, which of the following amounts would typically be paid as a capital sum, assuming standard policy provisions? A. $100,000. B. $50,000. C. $25,000. D. $10,000. Answer: B. $50,000. In an accidental death and dismemberment, AD&D, policy, the principal sum is the maximum benefit payable for accidental death. The capital sum refers to the benefits paid for specific dismemberment losses, which are typically a percentage of the principal sum. For the loss of one hand, foot, or sight in one eye due to an accident, the standard benefit paid as a capital sum is usually 50% of the principal sum. Therefore, with a $100,000 principal sum, the loss of one hand would typically result in a $50,000 payout. Remember that the principal sum applies to accidental death, while capital sums cover specific accidental injuries. Question 22. A life insurance policy is said to be participating. What does this characteristic imply about the policy? A. It has a fluctuating premium based on investment performance. B. The policy owner is eligible to receive dividends, which are a return of excess premium. C. It is sold only through employer-sponsored group plans. D. It provides a fixed, guaranteed interest rate on its cash value. Answer: B. The policy owner is eligible to receive dividends, which are a return of excess premium. A participating life insurance policy is one issued by a mutual insurance company, or by a stock company if the policy is designated as participating. The key characteristic is that the policy owner is eligible to receive dividends, which are considered a return of excess premium if the insurer's actual experience, mortality, expenses, investments, is more favorable than projected. These dividends are not guaranteed but reflect the company's profitability and are not considered taxable income, as they are a return of overpaid premium. This offers policyholders a potential share in the company's surplus. Question 23. Which of the following statements regarding group life insurance conversion privilege is true? A. An individual converting their group life coverage must provide evidence of insurability. B. The converted individual policy will always have a lower premium than the group coverage. C. The conversion privilege allows an individual to convert their group life coverage to an individual whole life policy within 31 days of leaving the group without evidence of insurability. D. The conversion privilege is only available if the group plan was terminated by the employer. Answer: C. The conversion privilege allows an individual to convert their group life coverage to an individual whole life policy within 31 days of leaving the group without evidence of insurability. The group life insurance conversion privilege is a crucial protection that allows an employee to convert their group term life coverage to an individual permanent policy, typically whole life, within 31 days of leaving the group, without having to prove insurability. This means that even if the individual has become uninsurable due to health issues, they can still obtain coverage. The premium for the converted individual policy will be higher than the group rate, as it reflects individual underwriting and typically a permanent policy type. This ensures continuous coverage for departing employees. Question 24. Which of the following actions by an agent would be considered misrepresentation under California insurance law? A. Explaining the difference between term and whole life insurance to a client. B. Advising a client to replace an existing policy if it's clearly in their best interest. C. Stating that dividends are guaranteed when they are not. D. Providing a client with an illustration showing future policy values based on current interest rates. Answer: C. Stating that dividends are guaranteed when they are not. Misrepresentation is an illegal and unfair trade practice involving making false or misleading statements about an insurance policy, insurer, or agent. Stating that dividends are guaranteed is a clear misrepresentation because dividends on participating policies are never guaranteed, they depend on the insurer's actual experience. Advising a client in their best interest or providing illustrations based on current rates are legitimate practices, while misrepresentation involves deceptive or untrue statements to induce a sale. Question 25. An insurer receives a claim for a life insurance policy where the insured died 3 years after the policy was issued. The cause of death was suicide. Which of the following is most likely to occur? A. The insurer will deny the claim and return the premiums paid. B. The insurer will pay the full death benefit. C. The insurer will pay the cash surrender value of the policy. D. The insurer will pay a reduced death benefit. Answer: B. The insurer will pay the full death benefit. Life insurance policies typically include a suicide clause, which states that if the insured commits suicide within a specific period, usually 2 years, from the policy's issue date, the insurer will only return the premiums paid. However, if the suicide occurs after this 2-year contestability period, as in this case, 3 years after issuance, the suicide clause no longer applies, and the insurer is obligated to pay the full death benefit. This provision provides a clear timeframe after which the insurer cannot deny a claim based on suicide, offering certainty to beneficiaries.